Okay, so I'm starting. So when we talk of finance, finance is simply managing the money, managing money. So whether it's your personal money, whether it's can you hear me? Hello, can you hear
Yes,
me?
yes, Doc. We can hear you,
Okay,
Doc.
Yes, we
whether it's
do.
Yes,
the
Doc.
finances
We
of
can hear.
um a business that is managing money. Now that's simply comprised of you being able to raise um income or money, then you allocate it, make decisions in such a way that you optimize the benefit of the money or you achieve your objective. Okay. Now we have subject areas in finance. Basically, when you go to school, there are a lot, but basically it can be broken down into this. The first one is corporate finance. And corporate finance is simply managing the finances of a firm. Okay. The next one is finance system. The finance system, sorry, financial economics. Financial economics is managing financial system. And when we talk of financial system, it consists of banking and non-banking institutions. It consists of financial instruments and it consists of financial market. Okay. Then we have investment. An investment is what committing your money into an asset, expecting what returns. Okay. So under it, we can have um, subjects like security analysis, portfolio management, financial market analysis. Okay. So that is uh, some of them. Then we have personal finance. Personal finance is managing your own finances. So we're talking of the finances of household, the finances of individuals. That is what we call personal finance. Then we go to public finance. That is managing the finance of a nation. Okay, the income that the nation generates and the expenses they make. All right, so that is public finance. All right. The next thing we are going to, we want to understand finance. You know, people confuse finance with accounting. People normally say, when I say, oh, I specialize in finance, they expect me to know accounting. When I say, oh, I specialize in finance, they'll say, oh, it's the same as accounting. It's not the same as accounting, okay? When we talk of finance, finance is a forward-looking concept and it's based on cash flows. We are interested in cash flows and we look into the future, the expected cash flows that we are going to get. Okay, so that is what we are interested in. But when it comes to accounting, accounting is historic in nature and it focuses mainly on profits. It focuses on profit. Okay, then the second difference is what finance, we are concerned with raising funds and providing returns to investors. Okay, raising funds and providing returns to investors. But accounting is provide accounting information to assist stakeholders in what making decisions. Okay, so basically that is it. The only thing that some people see in accounting that I don't know confuse them with finance is that they record their items or transaction in monetary term. They record it in monetary term. So sometimes people confuse it because we say finance people, we say we are managing money. So if they are recording in money, then they are thinking it's the same. And at first too, I think in the olden days, they used to merge them a lot in a firm, accounting and finance department. And even when you go to university, they used to be accounting and finance department. Okay, and it used to be only accounting. They became accounting and finance. Then later, finance broke out. Do you get me? So it was so in the olden days in a lot of firms. So people think the same. Okay. The next thing is finance, difference between finance and economics. Finance, we are concerned with what managing money, and economics is concerned with managing scarce resources, okay, to are employed to satisfy unlimited wants. Okay. Now money can be part of scarce resources because it's not easy to come by money, but um, like it is said that finance broke out of economics not long ago. So That is it. So now, even mostly, if you see someone who did economics, the person might think he has knowledge in finance. Okay, what is happening? Okay. Now, from there, we are going to corporate finance. And I said corporate finance is managing the finances of what? Of a firm, managing the finances of a firm. So you can see here that I've indicated managing the finances of an organization to achieve its objective. So as a finance officer of a firm, your role is to interact with the financial market. Why do you need to interact with the financial market? That is where you are going to raise money. That's where you are going to raise money. So traditionally, a firm is financed two ways, by bond and by shares. And shares, we see the as who become owners of the firm, then bond who become debt holders of the firm. So you should know the market, you should know. So if you were a finance manager in any of the listed firms in Ghana, you should know Ghana Stock Exchange very well. You should know how you can trade your shares. You should know how you can offer your even IPOs. You should know how you can run the market, how you can raise money through bond. So you should be familiar with the financial market. Okay. All right. And you shouldn't be localized. You should also know how to raise money internationally on all that, because we are in a digitalized system where you can raise money from anywhere. So that is it. The next one is control over resources. As a finance manager, you should have control over the finances or the resources of the firm. You should have control, you should be in charge. Mostly they know what is happening. If you are in a firm and you have a finance officer, if you don't take care, you will hate the finance officer. Because whenever you go for them to release money, they are very difficult people. They hardly release money because they have planned, they know the money available. They know that if they overspend, it's going to affect the firm. If they do this, it's going to affect the firm. So mostly, if you go to them for them to release money for something, it becomes difficult, especially if they didn't budget it into it. Then all of a sudden you chip in that there is a need for something. It becomes difficult, and if you don't take it, you think that the finance officer is hindering your operations. Okay, which is not so. They understand the finance of the firm. They plan how they can achieve the objective of the firm. A firm going into bankrupt depend on them, even though depend on all workers. But when do we say a firm has gone on bankrupt is when there is no money. Okay. And in finance, we believe in cash flows. If you say there's profit and there's no money there, if you say there's profit and there's no money, can you even pay dividends? If you say there's profit and there's no money there, can you purchase buy things that you need to run the day-to-day activity of the firm? So that is it. The next one is allocation of resources. For them, when they raise the money and come, they allocate it in such a way that the overall objective of the firm, which we know as maximizing the wealth of the firm, would be what achieved. So that is it. Then there are a lot of roles of finance managers, but I decided to bring these three. So you need to go and read. Okay, that's why I provide reference materials. The next one is financing decision. Financing decision. In finance, the finance officer or the finance department of a firm are always making decisions. And some of the decision is investment decision, financing decision, and dividend decision. Okay, so decision is they want to know. Normally, the decision involve should we do or shouldn't do. How should we do it? Okay, so the first decision we are looking at here is investment decision. Okay, now when you talk of investment decision, it's deciding whether to invest or not. Now, if that investment is long term, is long-term in nature, then we can compare it to capital budgeting, okay? Capital budgeting, where they have to do some analysis and decide and know whether investing in this asset or in this project is going to yield or is going to maximize the use of the funds we are going to employ. Now, whenever you say you are going to do investment, know that you are going to introduce capital. You are going to pump in money, okay, which is capital. And the money might not even be early at the initial stage. You might continue to pump in money, pump in money, pump in money for years. Okay, so you should do your assessment very well. Then you compare the cost and benefits. Investment decisions basically based on cost and benefits. So if the cost and benefits, if you realize that the benefit is more than the cost, then you are going to do what? Go in for it, okay? Now, after you have made the investment decision and you've decided to go into this investment, the next thing is how do you finance it? Okay, the investment requires money, so how do you finance it? Okay, now in financing, you want to decide the best way to finance it, how to raise money to finance it, and this is affected by various factors. Okay, now the first factor is the cost of the amount you finance with. So let's say they are going for loan, or please, please, your this thing need to be on mute. There is a noise. I don't know those who are not on mute. I don't know what they are doing. Okay, so um the finance decision, you are looking at what's the cost of the finance, what's the cost. So if the person is going for loan, if the firm is going for loan or is going to finance through bond, know that they are going to pay interest, and the interest is the cost of what? Financing. So you have to look at the cost. Two, you have to now look at the risk associated with the funds you are going to raise. Okay, so now we know that bond financing through bond is more riskier than what? Shares, because shareholders are owners and it's not compulsory for you to what? Pay them. So if the business is not doing well as at a point, you can sign not to pay any what? Dividend. Okay, but for bond holders it's fixed every year or regularly. You have to what? Pay them. So we see them as more risky, because if you default bond holders, we will term you as a corrupt oh, how do I use this term? Oh, hey, seriously, as the firm is collapsing, okay, I've forgotten the term. Bankrupt. The firm is collapsed, or the firm is in financial crisis. So that is how it's going to be. Okay. Now then, so this is how, and the next thing is level of control. Sometimes you want to do a project, you have agreed on it, but then shareholders are not ready to lose the control they have over the firm. So if you go and take additional shares, it's going to reduce the control they have over the firm. So they will say, no, we still want to be in charge. So if that's the case, let's borrow. So you go, then you raise the money through bond. Okay. The last decision is dividend decision. Dividend decision is whether they should pay dividend or not. Dividend payment is not compulsory. Okay. The firm will decide whether they pay dividend or not. Now, payment of dividend is dependent upon a lot of factors. One, is there any project they have to invest in? If there's a project or there's something that needs more money, then they are not going to pay dividend. Okay. Another thing is if how the income is it generating income? Is the firm generating income? Is the business generating enough income. When it's generating enough income or making enough profit, then they are likely to pay dividend, okay, or other things being held constant, they are likely to pay dividend. How dependent is the income? There are some firms, if they make profit today, it will take like 3 years before they will make another profit. So payment of dividend is not consistent, okay? So if the income generating is very reliable, like MTN, those people, no matter where they will make profit, you buy data. Even today, there's light out here. That's why the first this thing didn't work. So I'm not using the school data. I have to go and buy it. I have to buy it, call someone to buy me data so that I can use it.
Madam.
Please, no talking for now when I'm done.
Okay, that's
and
fine.
Please mute yourself.
Okay, that's fine.
The next, mute yourself.
Okay.
The next thing is sources of financing. Sources of financing. Funds can be raised internally or externally. And when we talk of internally, it means the funds was taken from within. Then we have what externally, maybe going to the stock market or going to the bank to borrow. That one is external, okay? But if you have enough money inside in your firm, you can use that one to finance the project, okay? All right. Now, the next thing we are going to is corporate firm. Corporate firm. Now, if you are talking of corporate financing, let's understand which people are involved in the corporate financing. Now, corporate financing, corporate finance happen when we are managing the finances of a firm. So we want to understand what is a corporate, okay? Now, when you talk of a corporation, we are talking of what? The combination or interrelationship between human being, materials, technology in order to produce or render service or make sales. Okay, so when you say that there's a corporate firm, it consists of materials, human being, technology. They come together, combine themselves to either produce something, to render service, or to sell. So that is a corporate or firm, okay? Now, we want to know the features of a corporate firm, okay? We say that there's interrelationship or combination of people, capital, technology, and material. This is what make up what a corporate firm. Now, mostly they are there to either produce or sell. Either produce or sell. They operate based on economic principles. They operate based on economic principle, a specific or mixture of economic objective to guide their operation. So either they have specific objective or a mixture. So some of them have various objectives. So we are going to learn some of the objectives of a corporate firm. Now, I would start with the second one, which we know to maximize owners' wealth, the wealth of shareholders, to maximize their wealth. How do you maximize their wealth? That is managing the firm in such a way that people will be interested. There will be demand for the shares of the firm. And when there is high demand, definitely the value of the share will increase and there will be capital gain. With that, if the price of shares are increasing for the firm, you are maximizing the worth of the shareholders because their worth is going to increase. Okay. Now, dividend too is a form of, so if you manage the firm such a way that they make enough profit and they are able to pay dividend, it's also going to maximize their worth. The next one is profit. The next objective is profit. Every firm wants to make profit. So that is their next objective, and that is it. The next one is to survive in the midst of competition. So when there is competition or political instability, like let's take for instance when there was COVID, at a point all firms are looking at is to survive. So when things like this happen, the objective will change to survival mode because a lot of things will be fighting the firm. So if you're able to survive, you have done well. The next thing is to what? The next objective is to grow or expand in terms of size, output, capital, or profit. So they always want to grow. If they make profits today, this year, the next year they want to make more profit. If their capital base is this, the next year they want to get more capital. If their size or is like this, the next year they want to increase in size. So you see that some will open branches, some have subsidiaries, some will move to other countries, other regions to what? Start the operation. Then the firm is growing. The next one is to what? Satisfy legal or social, legal, and statutory responsibility. So I will divide this into two. To satisfy legal responsibility or legal requirement, okay? So there are rules in Ghana, for instance. So if a firm you're operating, you have to meet that rule. For instance, if you have a bank, we have minimum capital requirement, okay? We have reserves and all that governs you. You have to go by them. That is legal requirement. The next one is social responsibility. That is social corporate responsibility, okay? As a firm, you have to, it's not by force, but it is an objective for some firms to what? To do certain social corporate responsibility. So sometimes some will pick some students, good students, and pay their fees. Some will build something in a community for them. They will sponsor programs and all that. Okay, so that is what we term as social corporate social responsibility. Okay, so the primary financial objective. The primary financial objective, like I said, is maximizing the wealth of a firm. Okay, but then people do not understand. Some people think when they make profit, they are maximizing the wealth. It can be, but it's not all that. Because there are firms that will make profit, but all the things they sold are on credit. There's no funds in the firm. Okay, so maximizing shareholders' what is the primary objective of every firm. Okay, and how can that be done? I've explained it there. I told you increasing in the price of a share. Okay, and that is maximize the value of dividend and capital gain. I've said it when I mentioned it. Okay, all right. So the concept of wealth maximization sometimes is vague and complicated, and people mistake it for other things. Okay. Some think maximizing profit is maximizing what? But then, no. Maximizing profit has a lot of challenges, like quantitative difficulty associated with profit. You know, if auditors come, I don't know, those who are working, see, auditors have come to your firm before. Bring 2 auditors, 3 of them, they will come out with different things. Because profit itself, there's no, you can't, all the factors that go into profit, it's very difficult for you to take into consideration. So it becomes difficult. The next thing is that the time scale for profit. Making profit look like short-term objective, but maximizing what is a long-term what objective. And then short-term objective need to be met, but meeting short-term objective doesn't guarantee maximizing the long-term objective. No, that's why I said some firm can make profit today. Within this year, they will make profit. The next year, they are not making profit. So profit is short-term, okay? Then profit does not take risk into consideration. Doesn't take risk into consideration. Accounting people, when they are preparing their financial statement, they will never bring risk. They will never take risk into consideration, okay? Now, the next thing people also think is if they maximize sales, then definitely they are maximizing what? It's not always true. Because there are instances people start firm and they are going in with penetrating pricing. Okay, they are going in with what? Penetrating prices. Okay, sometimes people do wrong pricing to their product, which affects them. So if you base on just sales to run a business, you are going to what? Fail. The next thing is survival. You see, I said in the midst of competition or crisis or political instability, the firm need to survive. Okay. But then, if a firm has a long-term objective of survival, will you invest in them? Will you invest in them? No one will buy the shares of that firm. Okay? No one is going to buy the shares of that firm. Okay? So that is it. The next one is social corporate responsibility. Social corporate responsibility. Social corporate responsibility. Now, social corporate responsibility involves spending. And when your spending increase, your income will reduce. Okay. So in as much as we are trying to satisfy the society also, we should know that the ultimate aim is to maximize the wealth of the shareholder. So we don't go and overdo it so that the shareholder will what? Suffer. Okay. We don't overdo it so that the shareholder will what? Suffer. Now, we come. How can you maximize the wealth of shareholder? Now, in maximizing the wealth of shareholder, I said from the beginning that finance, we are interested in cash flows. Cash flow. So you should know that you should increase the magnitude of cash flows. Okay. That's why we always work with cash flow. We always work with cash flow. The second thing, the timing of the cash flow. If you tell finance person that you are going to give him or her money next year, finance person know that the amount you are mentioning, 20,000, that will not be the value, because by the time it get there, that amount cannot buy anything. It cannot buy the worth of things it can buy now. So a finance person will discount it, probably based on the treasury bill rates or even based on the policy rate. They will just discount it to their current value. Okay, now to know the value. So we're always taking time into consideration, and we also take risks into consideration. So to maximize what we want to see the cash. Because if you want to pay dividend, the money should be available. Cash should be in your hand or at the bank that you can take. Okay, all right. Okay, so examples of good financial decision that promotes maximizing share price. Okay, all right. Working capital. When you manage your working capital very well, okay, when you manage your working capital very well, you know working capital, the current assets, cash, those things. Yes, you manage it very well. It helps to maximize shareholders' worth. Raising funds, we call it capital structure. Yeah, it's capital structure. Capital structure is the proportion of capital of the makeup of a firm's capital. So is it makeup? Is someone's destiny? I've told you to mute yourself. I don't want to know it in the video because I'll upload it. I don't know. Charles, please, you understand, when you come, you mute yourself. You mute Charles, who again? I don't want noise in the video. Okay. The next thing is NPV. I said I was talking about capital structure. So you do a mixture of you raise your capital in such a way, in a proportion that was going to maximize the worth of a firm. Now know that for every capital you raise, it comes with cost of capital. Cost of capital is what you are paying for. This is debt, you are paying interest. Equity, shared equity like this, you are still paying it. You are paying something because you pay dividend, you are paying something. Now you go to NPV. You do not get up. Finance people or finance manager will not get up and just invest in a particular project just because he heard that the project doing well. No, they don't behave like that. They will do analysis. They will assess it. And one of the modern way of assessing assessing one of the modern way of assessing a project is NPV, net present value. Net present value. In fact, all the others you find a level of NPV in it. Okay, so so that is it. Internal rate of return. There's NPV there. A profitability. What's the name of this thing? Is it profitability ratio? Yeah, there's NPV is in it. So we definitely use the NPV. Dividend policy. Dividend policies affect, in fact, share price, because if a firm is making profits and is not paying, they decide not to pay dividends. In fact, risk-averse person like me, I'm a risk-averse investor. I will sell my shares. If you don't know I invest in your shares and you make profits, it's not like if you didn't make profits. You make profits, I know to pay. I will sell my shares. Unless you have been paying profit for a long time, then once you stop. Or like GCB, when they had to finance the domestic debt, and it affected their profits, so they couldn't pay. I think that one they have justification. And the moment they made profit, they are paying dividends. Okay, so a average person like me, I will leave. I will sell my shares. And when people start, there's supply and people are not demanding for it. You know that your shares is going to what? Depreciate. The value is going to depreciate. Okay. So it will affect your what? Share price. Then taking account risk associated with financing decision. You have to know everything, there is always some level of risk associated with investment decision or whatever you do. So one of the ways to prevent this risk is hedging. You can hedge your risk, or you can take exchange rate risk. You are investing outside. You have to take exchange rate risk into consideration. Okay, so that is it. Okay, so we are going to financial market and institutions. Financial market and institutions. So financial market, then we have financial institution. Okay. Now, whenever you go to every well-functioning economy, there is flow of funds. Why? There are people who need money and there are people who have excess. Okay. So for the economy to function very well, those who have excess should release it. So those who need it will take it probably to do their own business. All right. So that will enable the economy to function well. Because if those who have excess decide to keep it in their bedroom, and those who need the money are not getting anything, at the end of the day, the economy is going to collapse. So there should always be flow of funds, okay, in an economy. And we have two ways that funds flow in an economy. We have the direct one. Direct one is like me coming to you and saying, Charlie, I need money. I want to sell Kenke. I need money. Can you loan me 500 cedis? Then you give me the 500 cedis. That one is direct. Okay, direct. So the person who has the excess money, who is called surplus spender. Then the one who need the money, who is also called deficit spender. So the surplus spender will loan the one who need money the money to go and do his business. So that one we call it direct. But then you know how loaning money to friends, people you know how it results. When you give them money, you don't add interest, but they will never pay. You will talk. Even not long ago, now you'll be reading on social media, that when you give someone loan, for you to even go for your own money, you have to explain why you need the money. When does it make sense? Because you took my money, you say you give it to me this time. Whether I have more money or not, it doesn't concern you. Whether I have an issue or not, you are supposed to pay. Okay. So because of that, we have resorted to the indirect transfer, which involve a financial institution or a financial market. So they play intermediary role. So we call it financial intermediary. And those who do that include bank, insurance, companies, mutual funds, include stock market. Okay, so if a firm want to raise money through loan, they will what? Issue bond through a stock market, so it's regulated. Okay, we are issuing this bond for 10 years. We are going to pay this interest over this period. Then when it's mature, we'll give back your money. It's being regulated. Now, okay, you go and deposit, you that you have excess money, you go and deposit it in the bank for safety, or you go and invest. Maybe you go and buy fixed deposit, or even treasury bill. Treasury bill is you loaning money to government, okay? Because when government read the budget this time, government said something. He said that the excess expense is going to finance it with loan from World Bank, loan from IMF, and domestic loan. That is treasury bill. So the treasury bill you are buying, government is borrowing money from you to run the economy. Okay, so you are borrowing money to the government. All right. The same way, bank, you go and deposit your money there. Some people, they will be having huge money in their account in savings. They are not investing so that these people will pay interest. Since these people will be using the money, will be giving the money out at a fee. Always make sure you have small money in your savings for emergency. The rest, you invest them, okay? So these people will pick the money and give it to those who need the money at an interest. Then they also have to come and pay you what? Interest, okay? So these financial intermediaries, they enable funds to flow in the what? Economy without, with minimum what? Risk, with minimum risk. Because if financial institutions and markets are not available, I don't think I'll give my money to some people. Because when I'm giving you money, my money is a gift. I don't give loan. And give loan. I don't give loan. I don't have strength for chasing people to fund my money. So if you ask me for money, the one that I can afford, I'll give it to you. Then if you don't pay, fine. That's the strategy we have adopted and we are going. Okay, so that is financial market and institution. That's what they do. Their main role is to serve as financial intermediary, enable funds flowing from surplus spending unit to deficit spending what unit. Okay, so that's the flow there. This is the direct flow, and then indirect flow. You see that this direct flow is like this. Now the financial market is inside, so it's not direct. Something is in between them. Financial, there's a seven as what financial intermediary. So name it financial intermediary. So your money go to those who have excess. Their money go to the bank, the financial market. And the financial market also pours it to those who need money and transfer it to those who need money. So that is it. Now let's learn about financial market. Financial market is a platform where financial instruments are traded. Securities are traded. Traditionally, we have bond and shares, but we have derivatives too. We've included derivatives. So that is it. So when that is a place that businesses, they borrow money and they offer shares. Okay. Now we have types of financial market. As you have said, type of, but there's another thing. So you know there's type of financial market. Okay. We have physical asset market and financial asset market. Now we have physical asset market, also known as is a platform where they trade rare assets. And by rare asset, I mean things that are tangible. You can touch, you can feel. Okay, you can touch, you can feel, like rice, table, laptops, and those ones, physical assets, also known as rare assets, okay, that where those things are traded. Okay, so we go to our market, they are traded. Then financial assets, we are talking of securities, shares, bond, derivatives, okay. So futures, forward contracts, options are traded. So that is financial asset. Okay. Now it can also be classified into spot market and future market. Now, when you hear spot, what comes to your mind? Spot market is a market that when they agreed on a transaction, when they agreed on a contract, they execute it immediately. They execute it what? Immediately. Okay, so yes, we are buying shares. Immediately you give me the shares, I give you, that's it. Then we have future market. Future market is where, yes, you come together, you agree that, yes, we are going to execute this transaction, but you will execute it in a future date. Okay, you will execute it in what? A future date. So you will set a future date. So no, this one, they agree on the transaction, they execute it immediately. This one will be executed in future. So they will give a date. They will give a date. They will agree on everything, the price, they call it strike price or exercise price. Everything they will agree, but they will execute it in future. Okay. Now, financial market can also be classified into money market and what? Capital market. When you talk of money market, we are talking of where short-term securities are traded. Short-term securities. And whenever you hear short-term in finance, in accounting, it's within 1 year. Short-term security. Example is Treasury bill. Treasury bill. Treasury bill, Treasury bill is within a year. So Treasury bill is an example of short-term security. Then we have capital market. This is the financial market where long-term securities are traded. Securities that are long-term, like shares. Because someone can buy shares for years. Bond, they are what? Traded. So that is it. Now we have primary market versus secondary market. Primary market versus secondary. Primary market is a market for trading new shares. So when a firm introduce new shares, they want to raise new capital, okay, then they design new shares. This is where they sell. Primary market, okay. The secondary market is trading of existing shares, okay. So after the firm has sold its shares and people have bought it, at a time, maybe if you're a shareholder, you want to sell it, then that's where you sell at the secondary market. You sell it, then the other person will buy it like that. So it doesn't go to the firm anymore to be trading between what? Others, investors, okay. That's what we call secondary market. Then we have private market and public market. Private market is made up of firms, small firm, mostly small firm. They are not listed. They are mostly not much recognized. When they sell their shares and they raise money through bond, we call them as private market. Then when we talk of public market, example is Ghana Stock Exchange. Ghana Stock Exchange is made up of public listed firms, well-known firm, very big. They trade there, okay. They trade their shares there, okay. So more organized than the private market, okay. Now that we are finished with financial market, we finish very soon. Let's move to financial institutions. Financial institutions is made up of banking and non-banking institutions. So that is it. Then we have them here. We have investment bank. Investment bank. When you talk of investment bank, they are mainly involved with underwriting investment. Okay. So what they basically do is they help firms to design new investment, and sometimes they buy it. They help them design new and attractive investment. Then they will buy it, and now they will now buy the investment and now sell it to individuals and firms. Okay. So basically that's what they do. They help with underwriting of investment and help people to invest. So they are serving like an intermediary between the firm and the investors. Okay, so that is it. Then we have commercial bank. We know that basically commercial bank, until recently they've added things to it. Commercial bank, their main purpose was to accept deposit, give out loans, have a safe for keeping precious things. Yes, but now commercial banks have turned to financial service corporate. I don't know what now. They are the reason insurance companies are even suffering in Ghana. Instead of them to be insuring loans that they take from insurance company, they've taken it themselves. They are doing insurance. They have in fact they've added a lot of things to it. But still they call themselves commercial bank. So now I don't even know whether GCB is a commercial bank, Zenith Bank is a commercial bank, but they are doing their own insurance among other things they are doing. So when we talk of financial service corporation, they undertake various activities. They do the activities of commercial banks. They do the activities of insurance companies. They do the activities of pension, everything. They do it. So for them, they basically do everything. Okay, then we have the credit union. Credit union, they are normally group of people who have something in common that come together to assist themselves financially. So they come together, they put money together, then they give it out to themselves as loan at a very reduced rate. So today, one of the financial institutions that have the lowest interest rate is credit unions. Okay, it's credit unions. So that is it. Pension fund. These people are concerned. Their function is to raise money from people to manage their pension for them. People, they raise money, so they will go into agreement and they write maybe regular amount that you have to pay. So when you pay that amount regularly, when you go on pension, then they give you bulk money or they give you money on regular basis. If monthly, then monthly they are giving you something. Okay, so they help investors to plan their pension. The next one is life insurance company. Should have been just insurance company because we don't have only life. We have insurance company that are in charge of motor vehicles, and we have the one that's in charge of life. Okay, these people will design policy that involve you paying really indemnity that involve you paying premium. I'm correct, right? Premiums. You pay premiums for over a period of time. Then when your insurance or something happen to a policy that's normally centered on protecting you against a risk. So when it happened, the risk happened, what they do is they will indemnify you. Indemnifying you mean they'll put you in the position that you were before that risk occurred. Okay, all right. We have mutual funds. Mutual funds also help people to do investment. They help them to do investment. So that is it. Now, recent trend in the financial market institution is we have advanced technology. So you can be here and invest in US stock, UK stocks. You can even borrow money from outside. So technology has advanced. Then we have globalization. Now the correlation between countries has become very high. Whatever is happening here is happening there. Imagine you can now invest outside, buy tradable outside. Is Ghana Stock Exchange not competing with US? Okay, is the firms and the Ghana Stock Exchange not competing with US firms? They are competing with them, even though they are not here. Because some people go and buy from there. Especially even when the dollars was strong, people would prefer buying there because at least their money is safe than Ghana cedi, which was then depreciating all over. Okay, so that is it. Now, in as much as things has become very easy for us with this recent trend, it poses some level of information, some level of difficulties. Okay, because now crisis can spread quickly. Money is moving around the globe at a very fast speed. Because I have my phone, I can send money to US. I can send money to UK. If you need money from someone from UK, the person can just send it. So it has put additional pressure on our financial market institution that they always have to catch up with this fast cash movement. Always have to take exchange rate into consideration, because initially importing and exporting was low, but now it's very high. People can be importing anyhow. Now you see, we have a lot of people who are operating in importation, small girls and boys. Initially, for you to do an importation, it wasn't easy, but now, because you can order online, so you can imagine. Okay, so these are some of the challenges we face. Okay, so that is it. I'm not going to teach time value of money today. I thought I've been taking it out. So today we'll end at financial market institution. Okay. So now you can unmute yourself, and if you have any question, you can ask. Hello.
Hi.
Please, are you okay with the lecture?
Yes, please. Very fine.
Did you understand?
Very fine. Yes, please.
Any question?